Our first theme is developed equities take centre stage. This is based on our view that the US economy has good momentum. In the Eurozone, helped by monetary policy, there'll be no recession and the slow recovery will gradually gather pace. And Japan should also be growing, helped by easier monetary policy and the lack of tax increases. Given all of this, we do think that there are three areas to focus on in equity markets. First, US large caps, which can benefit both from that recovery within the US and in their global markets. Second, M&A opportunities. Helped by the large amounts of cash on company balance sheets, we see a number of companies that should outperform as they become takeover targets. And third, European value. We're particularly focusing here on some of the European banks, which are trading on low multiples, and where finally we think 2015 will be the year where some of that value can be unlocked. And also European exporters, where although the valuations are not so attractive, they're really set to benefit from the ongoing global growth. Well, although the Fed is likely to be starting to raise interest rates in 2015, in Japan and in Europe, interest rates are going to likely stay extremely low and more liquidity be added. All of this suggests that current returns on fixed income investments, which are very low historically, will stay low. So where do investors find yield? We suggest three methods. First of all, in fixed income markets, selected opportunities, for example, in subordinated debt of banks and corporates in Europe. In emerging markets, again, where there's a good balance sheet, a strong external position for the country, both in the hard currency debt and in the local currency debt, and also selected crossover names in the US and Europe, but with very careful selection. The second way to get income is to move away from the fixed income space into equities and look for dividend-paying stocks. There are many solid companies paying still good dividend rates, and we see those as very well supported, perhaps even with the dividends trending upwards through 2015. Finally, investors can look to long, short and market neutral strategies as a way of generating income without broad exposure to the direction of the market. Well, oil prices have fallen sharply, other commodity prices have come down, and we think these prices will probably stay at much lower levels now than they were over the last several years. The reason being because of increases in supply, which really are tilting the supply-demand balance to a lower equilibrium price. How can investors profit from this? Well, we look at two main areas. First of all, within the US, we're focused on consumer discretionary stocks, as well as companies that are engaged in energy-intensive activities. The consumer discretionary stocks can really benefit as US consumers experience what amounts to a large tax cut from the lower gasoline prices. And of course, the energy-dependent companies benefit from lower input costs. Our second idea in this area is to look at selected countries, mainly in the emerging market area, that really benefit from the lower energy prices. Some large energy importers, ranging through from India, some of the other Asian nations, including countries such as Taiwan, and of course in the developed economy space, Japan. These and others benefit from the lower energy, the lower input prices, and we think selected stocks in these areas are another important investment idea for 2015. We see 2015 as an exciting year for technology stocks. We've got new exciting developments that are more and more coming to fruition, like the Internet of Things. Also, we've got a more conventional replacement cycle, where a lot of technology hasn't been replaced as quickly as it should be by its users, and now there's a backlog. So our investment idea in this area is to focus on those big Titan technology companies, also on innovators, companies that are really involved in those exciting new areas like the Internet of Things, and in addition what we call leveraged companies, companies that really benefit not from financial leverage but from being leveraged to the economic upswing as really you get that replacement investment and the need for new capital expenditure.